Hello, John. Welcome to the show. Let's get rolling by giving us a brief background about how you got started in wealth management.
Okay, Joe, thank you for having me. So you go to college and you think you want to be an accountant, and then you get into the accounting classes and you realize, oh my God, I don't want to be an accountant. But you get deep into the accounting classes and you show up at an economics and a finance class. You're like, oh, that's really interesting. And changed my major quickly. And my father had been in the financial services industry forever. So kitchen talk, dinner talk was all about finances. It was all about savings and markets and things like that. And as a kid, I thought never I wanted to be in the boating industry. I love boats, right? Well, 1987, 88, you have the excise tax put on the boating market, a 15% excise tax on luxury items, and it destroyed the market, right? I mean, literally, some of the big New Jersey manufacturers went from 1,000 employees down to 5. I mean, it just destroyed the entire thing. Coming into the early 90s, I thought, hey, I can, I'll come into the financial services industry and it'll be great. And, I joined the family business and applied all the information that I learned in college, and then got a real education and learning how this thing really works.
No, I agree. I mean, that's as Trump put it on his post, right? You learn by hands-on, right? That's how you get the real world, is you go out and do it.
I think, I have 4 kids. My idea of learning is go out and fail. If you fail, what you learn in the process of failure is so much better than me telling you what to do, because you're never going to be able to do it. My father, early on, when I joined him in the business, he's like, I can't give you any clients. Go out and get a client. He taught me how to get clients. He taught me how to fish. And if I didn't really understand how to fish, he's no longer, he's here, but he's no longer part of the actual operations here. You're not resilient. And the key in life is getting up, failing, fixing it, repeating it. Sometimes you got to repeat it 15 to 20 times. And then you go, oh my God, am I going to get this? Am I finally going to get this? Right. And I think that's the lessons in wealth. It's like this slippery slope is we get caught up in a lot of things and things look great. And then the risk was there the entire time. And all of a sudden the floor falls out and you're like, oh my God, how did that happen? And it's those lessons that we learn and how we apply them going forward, I think, are super important to wealth and creating wealth and keeping it. My new book, It's Your Wealth, Keep It, is all about keeping it. Learning from those lessons.
Do you think people just get too caught up in the moment usually and are not paying attention to the underlying risks in their portfolio?
Yeah, there's sort of like and I see this often. I mean, I've been doing this for 30 years, and I've seen people go from zero to millions and back to zero, right? And there's this bravado that happens that I'm invincible. I'm impenetrable. I am, Teflon. Nothing can, I've orchestrated this. And a lot of it is not. A lot of it is just happens to be right time, right place, being prepared, having the right skills. But you have to maintain that structure and that balance to say, I can't violate my principles, because when you start violating your principles of wealth, you take on too much risk, you take on too much debt, you go to Class C tenants thinking you're going to get a higher income. Whatever that is, you need to make sure that you really understand where the risks are. And risk is always accompanied with liquidity. And as you become more and more successful, is what is your level of liquidity and where is that liquidity and how do I access it? The banks will lend you a ton of money when you don't need it. When you need it, Joe, I don't think they're going to give that to you. You're not going to give you that loan. You're over leveraged at this point. They're going to give somebody with a low credit score a higher interest rate. Well, there's a higher chance of default. Well, you're just giving them a higher chance of default because it's a higher interest rate. So to answer that, that question is, you have to keep it in balance. You have to keep it in check. Just because you're successful here doesn't mean you're going to be successful. I see people take all their money out of their business. They sell it for a ton of money and they go invest it in this other business that sounds great. They know nothing about, and it's all gone. I've had companies get sold, the buyers buy it, and 3 years later, the company's out of business because they didn't realize what they were buying, and they try to fix it the way they want to fix it. Well, the reason why it worked is because it was working the way the guy was running it. You change too many things, like when a restaurant changes hands. Oh, we're going to tweak this and tweak that. Well, people were coming to the restaurant because they loved it. Big twists don't make sense. Although I just had a local restaurant totally rebadge themselves. And it was a high end restaurant. And he brought it to a double high, and redid the menu and redid the interior. And you can't get a table. It's months to get a table. So it's very successful.
So do you think, so a lot of the failures around, I guess, the clients that kind of take on more risk, do you think that's just a lack of planning? Is that a lack of writing it down? Or maybe you can answer by what are the things that work for when you're doing the planning for your clients?
Well, first of all, you got to have a structure and a set of rules, right? So one of the things that we like to look at is I have like 7 of these things, right? And the first thing is the strategy that I'm deploying. It has to reduce taxes today and in the future. It has to reduce risk, and risk comes from a lot of different places. We all think about investment risk, but risk is there's risk in mortality. There's risk in morbidity. I become disabled. I get sued. I have a long-term care event. My spouse leaves me. These are all risks that are going to, how is it going to work under different scenarios? I want to reduce fees and costs. Fees and costs are disruptors of wealth. But they need to be present in most people's plans because most people can't do it themselves. But my strategy should reduce those over time. I want to increase savings rate. How do you do that? By restructuring a plan properly, right? Because that's, the savings rate is the fuel that's going to, put gas in the tank to get you from, Jersey to California. I can't run my plan without having this, right? So in that, I want to make sure that I have more benefits and more protection around the wealth so that when I hit retirement, I can actually increase my spending without fear of running out of money, and then ultimately pass it to your family. I mean, you just mentioned to me that you have, young kids, and, I'd like to call them older kids at this point. They're still kids, but they're 24, 22, 20, and 16. I want to enjoy my wealth, but nothing will make me happier than giving them, the tools and the power to succeed, right? So those 7 things should happen. And most people, when you really look at the financial strategies that they're deploying, they're increasing their taxes, they're increasing risk, they're increasing fees, they're decreasing their savings rate, they're actually going to have less money in retirement, and they're going to pass less money to their family. They don't have to do it that way. And that's what's happening. And it doesn't matter where you are, it's happening, right? And we can go through examples of it, but I can get from $1 million to $2 million, and I can get there with no tax, or I can get there with, 200,000 of tax. Which strategy is better? The one with less tax. But if I deferred all my taxes from, a 20% bracket to a 40% bracket, maybe that wasn't too smart either. My biggest fear is, Biden in the new tax law, he's talking about capital gain and anything above $1 million going to 39.6. Mm-hmm. And you talk about a real estate investor, you talk about a stock investor. That's a significant deterrent to sell anything or in its value. I mean, imagine you've been depreciating, your asset. They didn't talk about what the depreciation recapture would be, whether it would still be 28% or not. I doubt it. And then you got this 39.6% capital gain rate, which is, right now it's 20 at the maximum side. I mean, that is the difference of millions of dollars in a lot of transactions. That's going to hurt the real estate market. It's going to hurt things. It's going to, that's where you get into what's my exit strategy? How do I get out of these highly appreciated properties without paying taxes? And that's strategy, right? So I'm concerned about this.
And they're proposing that, I believe, over $1 million a year, right? Is that what that proposal is?
Yeah. So it's, anybody with $1 million and higher income, yeah, you're at 400,000, you're at 39.6. You've hit the top bracket. But if you have a gain of over $1 million, that triggers 39.6, the way I read it. So you sell a piece of property that has a gain of, $1.2 million, you're paying 40% tax, 39.6 plus the state that you're in.
Got it.
Plus some other Medicare taxes, et cetera.
So when people, I guess, clients are coming to you now in 2020 and they're looking at what may come down the road, what are those tax strategies that you're implementing today and advising the clients?
One of the first things that you have to take a look at is, in the current Trump tax law, you have qualified business income, 199A, right? Are you optimizing 199A? Like, what's your business, real estate or self-employed? Are you getting enough income, salary versus profit, to get the benefit of the QBI deduction? And that QBI, if you don't know about it, if I own an S corporation and I pay myself, let's say I pay myself a salary of 100,000 and I make 100,000 of profit, that 100,000 of profit is going to be able to get a 20% deduction depending on, certain laws, right? So I'm going to pay tax on 80 versus 100. That's powerful. Extremely powerful, right? I've encountered a lot of people where their corporation, they're paying themselves $700,000-800,000 a year in salary, subjecting it to, Medicare tax. If I could stutter more, that would be great. But that tax is there, but then they're only showing $100,000 or $200,000 worth of profit. So now they've got the tides turned, right? So there's a concept in the tax law called reasonable compensation. Nobody knows what the heck it is because nobody's defined it. But as a business owner, if I pay myself $200,000 and have a $600,000 or $700,000 QBI deduction, that's really powerful. That's a 20% on the $700,000. That's $140,000 I'm not paying taxes on. Now, should I defer that into a qualified plan to pay future higher taxes? No. I should put it somewhere where I can get future tax-free income. So the first thing is you got to really look at what the heck does my current tax return look like? And my business tax return flows over to my personal tax return. Did I do everything in the business to maximize depreciation? If you're a real estate investor, interest rates are at what? All-time lows? Maybe the lowest?
Pretty much the last few weeks, right?
Pretty much, right? So, and valuations in a lot of areas are up dramatically, except in the major cities like Orlando and Manhattan and, Phoenix and California. But what a great time to refinance your properties and get that into that optimal debt to income ratio, right? What is that for the individual investor? It depends on how much cash that they have. But if you could take some chips off the table and put some cash getting ready for the downturn and reduce your cash flow on those expenses, you increase your cash flow, you're going to lose some tax benefits because you're going to minimize your interest deduction, but it's going to, with real estate, depending on how it's structured, you have QBI, which is really valuable, right? So you look at this and say, in the business, whether it's real estate or my, manufacturing company or whatever you have I optimized the cash flows, the depreciation, the anything I can do in my cash flows to put more money on my personal return. And then on the personal return, how do I optimize that? Because if Trump is not elected, Biden is going to overturn that tax law as quickly as they possibly can, right? So the SALT deduction comes back into play. Mortgage interest comes back into play for many, many people. If he doesn't, in the 2025 tax law, 2026, the law is all sunset, okay? So, what are you doing on your plan, in your strategy? Like even people are accelerating their mortgages right now. They're refinancing. They're going, gee, I can get a 10-year mortgage for what I was paying on a 20, or I can do a 15 versus what is a 30. And if you look at that, we talk about 5 rules of the institutions, right? And the 5 rules are basically saying, if I'm a financial institution, my job is to make you feel comfortable about giving me money. Okay. All my marketing, everything that I am doing, I've got a low interest rate, on my 15-year mortgage or my 10-year mortgage. And then the second thing is, once I'm comfortable, I want to get that money as quickly as I possibly can. So rather than doing a 30-year mortgage that's, let's say, 3%, you could do the 2.5% if you do a 10-year mortgage. So I'm the financial institution and I get money quicker. That's good for me, the financial institution, right? Because I can turn that money and lend it back out. When I give it to them, they want to hang on to it for as long as they possibly can. So all the strategies promote, dollar cost averaging, dividends to reinvest, hang on to that money. The financial institution wants to hang on to the money for as long as possible. And then they don't want to dole it back out to you. Don't take it all out at one time, Joe, because you might run out of money. So leave it with us, the financial institution. We're compounding our fees. We're compounding your taxes. And then, oh, by the way, we are going to change the rules on you. We're a financial institution. We're going to change the interest rates. We're going to change our fees, life insurance policies. We're going to raise the mortality rate. You start seeing all these crazy things. And what people don't understand is that, think of where are we in the interest rate environment? I'm 52 years old. It's never been this low. All right. My father's 77 or something like that, right? Never been that low. Do I want to pay off this debt quickly? I don't think you do, depending on who you are. But like, if I had 2 strategies, a 30 versus a 15, and I took the difference of the payments and I said, I'm going to take the difference of the payments and put it in a side account, mortgage cancellation fund. Right around year 14 to 16, without the tax benefits, I should have enough money to pay off that mortgage at like a 3% internal rate of return on that money compounding over that time frame, right? Where's the interest rate going to be 15 years from now?
Well, I sure hope it's going to be higher, but who knows in this world anymore, right?
Right. And I've been saying for 12 years that interest rates are going to rise, and I've been dead wrong. But let's just say 12 years from now, I've got $400,000 sitting in my mortgage cancellation fund, and it's making 7% in the bank like it was 12 years ago. Do I want to pay off a 2.75% mortgage? Absolutely not. I want to be in control of my money. I want to put that money to work. I want to buy things, right? If interest rates are 7-8%, housing values will fall. It should, right? Economics, it's going to cost more to maintain it. So housing, if I have cash that I didn't prepay my mortgage, I can now put that money to work, where everybody else has got to go refinance at 7%. I mean, I saw this early on in my career. People would come in and they have these massive home equity lines after owning the house for 20 years. I'd be like, what's up with that? And it turns out it was because they had to put their kids through college. They didn't have money on the outside. All the money was sitting in there. So they were going back into debt, now paying 7.5%, 8% on these home equity lines back at the time. And for 30 years, interest rates have been falling. So they've been benefiting from that, but they didn't have enough liquidity on the outside to hit these other goals, right? And so when you're in your plan, you want to look at is what is every single way that I can reduce my taxes? Have I maximized it, right? And more importantly, when the tax law changes, am I going to, we don't know how it's going to change, but let's assume that it sunsets and Trump does get elected, right? So it sunsets in 2026. Is my plan set up to benefit from that tax law? And the answer to that question is I've got to maximize mortgage interest deduction in that time frame. Right? I have to look at, should I be putting money in 401k versus 401 Roth? I believe we're in the lowest tax bracket, one of the lowest tax brackets we've been as a country for a very, very long time. Deferring tax, I don't know. I don't know if it really makes sense, especially with all the Fed stimulus that we've seen, right? Somebody's got to pay for it.
My only concern there, I totally agree in the fact that, getting involved in all Roth accounts is, my opinion, the best. And that's what I personally do. But just the fact how they kind of got rid of the stretch IRA from the inherited part, like you just don't know where, one day they might just make a decision in some aspect to change the rules, right?
Absolutely. Somebody had, and I can't think what the name of it is. Hang on a second. But there's a document that's circulating that, and I've known this for 25 or 30 years, that the IRS technically has the right to confiscate the money in your qualified plans, all of it, regardless of whether it's Roth or that, right? And they can do that through excise taxes. When Clinton was president, there was a 15% excise tax on all qualified plan distributions. So translation, if I was pulling more than 160,000 out of my qualified plan, I paid federal tax plus 15% excise tax. If I died with more than 750 in the plan, the family, that's income in respect of a decedent, and the family owed the regular income tax plus 15% excise tax. And back in the day, you didn't have a stretch IRA. This was before stretch, right? So you had to collapse the IRA within 5 years back then. Okay. So then comes the stretch, which says, oh, mom dies. I get to roll it over into mom's name deceased IRA for the benefit of me. And now take this little tiny RMD, required minimum distribution out based on my life expectancy. I might have been smarter taking it out a few years ago when these tax brackets are low, because now I'm deferring it. Enter the Secure Act, which everybody's forgotten about because of COVID, right? Which came out at the end of last year, which says no more stretch. Now you're going to take it down over a 10-year period. Now, if I inherit $1 million IRA, I don't have to take it out every single year for the next 10 years. I can defer it to the 10th year. What's my tax going to be? And if I have $1 million and I take 100 out a year, that's going on top of my current tax. It's pushing me into this higher bracket. If I'm, in the Biden tax law, about 400,000, boom, I've got a Medicare tax of 12% on top of the 39.6 that he's proposing. So you have to have this, here's what I don't know. My grandmother gave me this crystal ball day one when I entered the business, and I was having a conversation. I knocked it off my desk and it shattered into 1 million pieces, right? So I've been lost ever since, right? But what I know is you gotta have multiple strategies going on at the same time, because Roth may be right. In a perfect world, I defer from a 50% bracket to a 10. That's a perfect world. Well, if I'm in a 10% bracket, I probably don't have enough wealth, right? And then this other side, but what Biden's proposing is not only the Medicare tax in the 39.6, but in the 401k market, getting rid of the deduction and replacing it with a tax credit at 26%. Well, if you're making above 400, the deduction was worth way more than the tax credit of 26%.
With all these tax increases and Biden gets elected, I can't imagine that a lot more people will leave California and New Jersey and New York and these high state, income state tax states, right?
Yeah. I mean, California, I think it's got a 10%. New Jersey has, we're talking now, there's a millionaire tax above it. You've got a higher tax. If you make more than $1 million, we're pushing 8.5 to 9 before that. People are fed up with paying taxes. At least California has lower property taxes than New Jersey does, but not much. North Carolina's got better, right? But New Jersey is leaving in droves. I think somebody told me there's 6,000 people a month heading south. They're going to Delaware, North Carolina, South Carolina, Florida, Georgia. My client base is slowly, the geographic was, heavy New Jersey. It's now Florida and up. It's just, not many people going west. There's no gold out west anymore, right? So we're not going out west. But, we're going to the tax havens. You want to get to the places where you don't pay taxes. You want to go to New Hampshire. You want to live free. I just, when you look at wealth, taxation, current taxation, and deferral of taxation it decimates it, right? So the tax law is everybody's talking about Trump and his audit, right? And his $75 million refund. If you lost a couple $1 billion in a transaction, the tax law allows you, before Trump became president, to continue to carry forward those losses indefinitely. You'll never pay tax again on anything. I mean, if you're real estate and you went through 07, 08, 09, you lost money. If you're a developer, you lost money. You'll never pay taxes.
Everybody did.
Yeah, you might never pay taxes again. All right. So if you're smart the way you were doing it, realizing losses is an important part of this. So you think about, and I think one of the things that you wanted to talk about, that we talked about earlier, was the concept of, okay, I own a piece of property, whether it be, a piece of real estate or a highly appreciated stock or something, and getting rid of it, right? So in my book, we talk about, chapter 6 has this thing called the beautiful balance, right? Which talks about this, having cash. I'm a proponent of cash value life insurance so that you can utilize the cash values, but more importantly, the death benefit. And I want to use the death benefit creatively during my lifetime, right? So I start thinking about a future where if the capital gain rate goes to 39.6 and I own a highly appreciated piece of property, I probably don't want to sell that. I want to do a 1031 exchange. Well, what if they take away the 1031 exchange or put massive restrictions on it? That would single-handedly overnight destroy the real estate market. I don't think they're going to do that. Right? But sometimes, like right now, there's some pretty crappy deals out there that people are buying in their 1031 exchanges.
Definitely over the last year, I've seen a lot of deals just trade for the fact that 1031 way overpriced per door. I couldn't believe it. It seems like you may be leaving one good deal for a bad deal.
Maybe a worse deal. Even these opportunity zones, like all the opportunity zones, the amount of money going into the opportunity zones is off the charts. Like valuations are double and triple what they were worth only 5 or 6 years ago. Okay, right. So let's say that I bought a piece of property for $1 million and it's, and it's worth $4 million, right? Well, if I have to get out of that with a 50% tax, you look at what's this $4 million piece of property producing in income. If I sell it, assuming no debt, and I got to pay 50% tax, I'm only going to have income. So 4 million net after tax, 2 million, rough math here, right? Not counting for depreciation, recapture, et cetera. Just using this high end bracket, $2 million put in the bank at, 4% is $80,000 a year. It's not that exciting. All right. So one of the things that I think through is if I have a life insurance death benefit that's significant, that's going to be here upon my death. Let's say I've got a $4 million death benefit that's permanent. That allows me to look at the tax law and say, what's this concept of a charitable remainder trust? Okay. So I say, I'm going to set up a charitable remainder trust and I'm going to gift the property and sell, and the property will get sold inside of the CRT, the charitable remainder trust. So when I do that, there's no tax on the transaction. So the charity, the trust sells the property for the 4 million. The 4 million goes into an account that I have a lifetime income from. And I'm at the same 4%, I'm going to get $160,000 a year versus 80. And when I do that $4 million deduction, that gift, I get a tax deduction I might get, if I'm older, I'm going to get a higher one because it's what's left over goes to the charity. Most people are like, why? I don't want to give $4 million to a charity. I mean, I love the charities, but I don't want to do that. Right.
No.
So, but what's left over is what goes to the charity, right? How much more income can I get over a 10-year life for 80 versus 160, right? But I'm missing that principle. Now, let's say that I get because I'm 65 or 70, I get a $2 million deduction on that $4 million. How am I going to use the $2 million of deduction? Yeah. So I look at the plan and say, hey, I might have $2 million in my qualified plan. Taxable. Let me convert it to a Roth. Let me sell another piece of property that has really crappy basis, meaning it's zero basis or negative basis because my accountant over depreciated it, right? And use that to offset that actual gain. So if you did that, if you think about it, $4 million piece of property, sell it, you have $2 million net. That's going to give you $80,000. And I now have a $2 million IRA at the same 4%. It's going to give me $80,000 taxable. So I'm living on, 160 net after tax. That's not that exciting. I mean, it is, but it's not, right? So I do the charitable remainder trust. $4 million goes in. I'm getting 160. I convert my 401k IRA to a Roth. And I'm now getting $80,000 tax free. That's simple math, $240,000 versus 160 taxable. That's a lot more exciting. Now, if you think about, let's say I have a life insurance policy, a whole life insurance policy, one of those old ones that's making 4 or 5%, right? Plain, boring, terrible thing. But it has a $4 million death benefit. So the 4 million I know is going to come in at some point in time, right? So think of it as a permission slip. Think of it as, how can I spend the death benefit while I'm alive? Because I just want to frame a conversation for a second, right? Is if I'm worth $5 million, the goal in my estate plan is to get my kids $5 million. Not 10 million, 5 million. All right. So if I have a $5 million life insurance policy and I have a $5 million estate and I died yesterday, my kids are getting 10 million. That means I didn't have as much enjoyment from my money as I should. All right.
Yeah.
So we look at this and now say, well, think about the death benefit in a different perspective. If I've got that $4 million policy that we were talking about, and that $4 million property, right? That's a permission slip to do the charitable remainder trust. My kids are still going to get the asset. And if I live a long time, I got a lot more income than I would have if I had sold it and kept it, right? I've got more cash flow to do different things with. I look at this and say, as we head into an unknown inflation rate, right? Because I think inflation is here and I think it's mass. I mean, cars are through the roof, cheese is through the roof, milk's through the roof, right? Inflation is much higher than we believe it to be. So we're in it and the government's telling us, oh, it's very low, very, 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 very low, right? So, okay, great. So we look at this and we say, my goal is to spend all my money before I die. And I want to get it as tax efficient as I possibly can. So a charitable remainder trust is super tax efficient because the money, I don't have to worry about selling, I don't have to do anything, right? So the life insurance death benefit becomes the permission slip to spend it, to do the charitable trust. There's a concept called the reverse mortgage, right? I love houses. I think houses are fantastic. But if you really look at what they cost, they're horrible.
Mm-hmm. Yeah.
Right?
And money,
right? Money freaking, but every time you turn around, it's like, what? I got to write a check for what? I just bought a new house. We got to get, a fence. I'm like, seriously? Fence costs that much money? It's a small piece of property. But the idea is that, eventually I'm at the point where we mentally convince ourselves that we're going to sell that big house and move to a smaller house. You just worked for 30 years to get the house paid for. Now you can finally enjoy it because you've built it, but now you're going to sell it, right? Well, what if that same life insurance policy, do the kids really want your house? No, they don't want your house. They have their own house. Unless it's a special piece of property, like on a lake or a river or something like that. But that's different. This is your primary residence. Most people don't want the primary residence. So I look at this and say, I got $1 million policy. Why don't I do a reverse mortgage? I'm 70 years old. My house is worth $500,000. It's $25,000 tax free. How much do I need to take out of my IRA to get $25,000 tax free? A lot more.
Yeah.
All right. So this is not a conversation of that's better than this, right? Real estate's better than equities. Equities are better than life insurance. Life insurance is bad. Annuities are bad. All this stuff is investments are bad. No, none of it's bad. It's how do you use it so that you put it in your plan efficiently to say, if I'm going into the higher tax bracket, what's my exit strategy? It may make sense to defer 100% of your money into qualified plans because you have an exit strategy because you not commingled it, but you married it with real estate. Well, if I can do this charitable trust, I can get all my money out of the plan tax free. I know how to do that.
And so
it's about strategy. Go ahead.
And I heard you mentioned charitable remainder trust, and I've heard of charitable lead trust. And kind of, what are the differences, or how do you advise like a client to choose one over the other?
Well, it really comes down to payout, right? So you really want to understand each one has a different nuance. You're going to get a bigger tax deduction because there's less income. It depends on the individual and the person, right? And I am talking about a lead trust. I am talking about a remainder trust. And there's nuances within there that when you sit with your attorney and you sit with your cash flows and you sit with your advisors, you're going to make a decision as to how that charitable trust should be structured to maximize the income and also the tax benefits. It really depends upon who you are at that moment. They're all fall into the same category in my mind, right? I'm going to give a highly appreciated piece of something to it and in turn for an income stream. And how long is that income stream going to be? And how long, the longer it is, the less deduction that I get. So, same thing, just different terminology. And it's the attorneys are going to unwind that the right way too, if you have the right attorneys.
Yeah. And so many people, I guess maybe when they first initially think or hear about donating to charity, maybe, everyone obviously has a certain side that they want to do benefit to charity. And then there's a certain side that they have to have profitability in order to survive. Right. And so typically how do people wrap their head around quickly, like, is this viable for me, or does it even make sense financially? I think
A charitable gift only makes sense if it's a small percentage of your assets. I've seen people do charitable remainder trusts and then they take the tax savings and they buy the life insurance when they're 70 years old. Mathematically, they didn't win from that. They would have been better off doing something else. The advisor did extremely well. Okay. To me, you want to get it set up and you want to have all these things in your plan so that if you're sitting in a room and there's, two windows and a door, which way and you're going to paint the floor, which way you're going to paint, towards the window or to the door? Well, how high is the window? Is it a third story window? And then my only way out is through the window? That's not a good strategy, right? So I want to figure out a way that I can paint to all three at the same time. So I can look at it and say, what's the best way for me to get out of here in the event that there's an emergency, right? So, if we're in a 50% tax bracket and I got to sell the property, because a lot of properties go into what I call no cash flow, negative cash flow. And you need to get out of it because it's just sucking you dry. Okay. Different strategies are going to make sense at that time frame. I mean, where is the property owned? How you own the property, I think, is really, really important. Also, I see a lot of people holdovers from the 70s where real estate, highly appreciated real estate, is in C corporations, not not LLCs, but C corporations, which means I sell it, the corporation pays a tax internally, and then the distribution, you pay another tax. You're talking about a 60 to 70% tax between the two layers. So you really have to look at is how do I unwind these things before I make a decision? And to me, what we do is we do this concept called blueprinting. It's called the wealth curve blueprint, which is a snapshot. Let me take everything that you own and put it into an organized manner and understand where you are, and then take it and simulate it. If you change nothing, where are you going? Now apply financial pressure. Apply a higher tax rate, apply no tenants, apply, sideways market, kids going to a college that you didn't plan for. What's the impact of that? The good news is the kid's in Harvard. The bad news is you've got a state school plan. You have to understand where you're going. And then, if you haven't done a lot of planning, a charitable trust probably doesn't make any sense. Right? If you've done a lot of planning as a potential exit strategy, then it makes a tremendous amount of sense. There's going to be a button or a switch that you're going to flick on that says, I'm in this environment that you think about it. I did a video, it's on my YouTube channel, and it's the history of the US marginal tax brackets. I go back to 1913. And there's a period of 21 years where the tax bracket, the top marginal bracket, is 90%. 90. Jack Nicklaus first. No. Problem is you had to. Jack Nicklaus, first year on the golf tour, I think it's 1964. He makes $100,000. And they're interviewing him in the early 90s. How is Clintonomics going to affect you? And he says, not that bad. My first year on the tour, I made $100,000 and paid $90,000 in taxes. How bad is Clinton tax going to be? Right? It's like, well, if I'm planning and I'm deferring into a 90% bracket, which I don't think we get there, but the trend has been, let me take away every single deduction that you have and keep exposing more and more money to taxes. So like Biden goes from 37 to 39.6 in his tax law, but instead of getting to 39.6 at 600,000, it's get there at 400, right? And then, oh, by the way, let's add a Medicare tax of 12 or 12.5%. That's a 52% tax bracket above 400,000. So, I got 21 years where the top bracket was over 90%. I better have some good planning along the way to get me out of that. Conversely, if the tax, if Trump wins and he says, I think the thing he tweeted over the weekend or somebody did, he's going to have the greatest tax cuts ever. That might be a spot where, 1031 exchange makes 0 sense. Pay your tax and run. 15 to 20% is one of the lowest brackets in the history of the world. Sometimes it just makes sense to pay tax. People doing Roth conversions, they're paying the tax. I don't know if that makes sense. A lot, like if I have $100,000 in my IRA and I've got $30,000 in cash and I do a Roth conversion, I got to give up Uncle Sam $30,000. Now I lost the compounding effect of that $30,000. What could I have done with that $30,000 in my plan to create more wealth? I mean, if 100 compounds at 8% versus 130,000 compounding at 8%, which one has more money? You don't need a calculator to figure that out.
Yeah. 130, right?
130 is going to win. All right. So my point is, the financial institutions are giving us like this stuff. The corporations are coming at us like the cars. Ooh, you got a new tailpipe. You got to get this new car. And they've got us on the leases now, right? Every 36 months, you got to get a new car. Everything's changing. And at the end, the long-term care companies are coming in and saying, we've got a wonderful home for mom and dad. You don't want to take care of them. It's gonna cost you $14,000 a month. It's going to take all your parents' wealth and you're not going to get any of it. Nobody wants that to happen, but that's what's happening. And you need to arm yourself to really look at this and say, am I in control, or is the financial institutions and the government and the corporations in control? If I don't understand the rules, that they're in control. Even when I understand the rules, I got to deal with these suckers every single day. And how do I deal with them? Right? If I don't know the rules, I'm just lame duck. I'm going to get run over.
So do you guys typically, when you're laying out that blueprint for your clients, is that something that's like a consultation, and then from there you guys do implementation, or, what can people expect?
So the blueprinting process is kind of interesting. The way we do it is we do an introductory call. We spend about 30 minutes on the phone where we just get to know you. We ask you a bunch of questions. And for most people, it's all about you. It's nothing to do with us, right? It's tell me about you and your family. Tell me about where your income is. Tell me about your taxes. Usually when I say taxes, people are like, I don't know. I don't know how much money I pay in taxes. Where's the money going into savings? What's your debt structured like? What's your lifestyle like? Where are your current assets? What are these future obligations that you have? College, weddings, all that wonderful stuff, goals. And then how's the wealth protected, right? Do you have an umbrella? How many people on this podcast don't have an umbrella liability policy? They're now sitting here saying, what are you talking about? What the heck is that, right? So if I get sued and my property's in an LLC, I have some level of protection. But if I get sued personally, everything that I own is subject to my creditors, right? I was driving in my car and I ran over the person crossing the street. I didn't, but I'm just saying, if that happened, I'm going to get sued, right? I'm going to get sued, right? Because I was texting while I was driving. I mean, that's like a common thing, right? So asset protection becomes like this super important part. So the conversation, that 30, 40-minute conversation with myself or one of my other advisors is, you're going to know at the end of that time frame whether this is going to be a good experience or it's not going to be right for you. And then what we do, depending upon who you are, okay, if you're a business owner with complexity, there's a fee for that. And then if you're a corporate executive, there's a lesser fee because it's not as complex. If you're starting out, it's a really small fee to go through this blueprinting process. And what we do is we take everything, we organize it, we give you the blueprint, we have a scorecard that ranks you in 38 different categories, and we walk you through, here's where your issues are. We explain it to you, and you can walk out of that thing and go, that was a really great experience. I really love having this thing organized, and we can do the organization for you every single year. Most people then go, okay, I realize I need help. And in order to do this, there's strategy that needs to be put in play. We need to redo wills. We need to redo our property and casualty. That's mean getting an umbrella liability policy, right? I need to do life insurance. I need to do disability insurance. I need to open up a savings account. I need to do a 401k. I need to do whatever it is. We're going to help you coordinate that. Some of those areas we're going to earn a commission or a finder's fee. Some of those we're making direct referrals to great people that do great work. I mean, in the last think about the amount I've recommended so many refinances in the last 60 to 90 days. I would be the top mortgage broker out there, but we're not, right? But it makes good sense, right? And so that blueprinting process is really designed to come in, work with us, and not, have an independent, we're certified for financial planners. We have all the licensing. We have a registered investment advisory firm. We have Series 7 licenses. We're licensed in life and health. We have Series 63s. I mean, I've been doing this for 30 years. This is what I do. All right. And we're going to figure out, what does Joe need to do in his plan, and who does he need to get with to get this stuff done? Some of it I can help you with, some of it I can't. And that's really, to me, you start there and exactly. I mean, I don't mean to go off on a tangent, but that's what I do. But most financial companies are pitching a product. The product is buy my investment XYZ. It's the miracle product that's going to save your life. All right. Buy gold, buy real estate, buy life insurance, buy an annuity. Don't buy an annuity. Annuities suck, right? All of them are good stuff, used properly. The idea is that, get a strategy, then figure out the financial products, right? It doesn't matter what bat or golf club that I'm going to use. right? Do I have a good coordinated swing? If I don't have a good coordinated swing, I could get the best clubs known to mankind. Like I took a tennis lesson on Saturday morning. Like my swing was all messed up. She worked with me for an hour to get my swing right. It didn't matter whether I had the best tennis racket or not. My swing was terrible. Work with a coach for a while, get your swing right. Then you can go get a better product. But, Tiger Woods can use like the worst club ever, my grandfather's 1952 clubs, and beat me at golf, right? It's because he has a coordinated swing. And that's really where we want to focus is on, where's your swing? Like a lot of clients have come to us, all their money is in their business, okay? They don't have any money to invest. Well, the sole purpose of owning a business is to get as much money out of it as you can personally. So let us help you get it out over the next 20 years and sell it. And when you sell it, now you got a great strategy because most people sell their businesses and they don't have enough money to maintain lifestyle because they didn't build enough wealth outside first. Strategies, real estate, whatever it is, right? So it's a process that is designed to help you get that clear macro view of everything that you have, not just one part of your plan. Don't focus on one thing, focus on the big picture.
Do you think a lot of people just get overwhelmed or intimidated by the whole process and just continue to pay taxes? Because I feel like there's definitely a lack of planning out there amongst a lot of, investors or people that are just higher, income earners.
Yeah. There's a lot of it. There's a couple of things that are happening. I think there's, most people when they come to us, they're like, I've been looking for this for like 30 years. I didn't know that it existed. Now that I wish I found it, 20 years ago. I hear that frequently, right? But there's also this like mindset that like, I might be in the community and I haven't accumulated the amount of wealth that I want to accumulate. Now I'm going to go disclose it to this person that might know people in my community. I don't want to fess up to it. I don't want anybody to know. And I go along in my merry way. And I'm saying, I don't care what you have. Like we don't have minimums in our firm. Like we work with people that have futures. Like if you have a future, I want to work with you. Right. And we have the structure set up the way we can do that. And there's also this sense of, and a lot of my Wall Street clients, all of their friends believe that why would you need a financial advisor? You're on Wall Street. It's all the stuff I don't know. It's all the stuff I don't know. It's the wills, it's trust, it's all the other stuff. And they love, it's like you need a person that's going to coordinate all the details for you. They're going to look at the tax return. They're going to look at, are you optimizing your benefits? If you, go into your personal profit and loss statement, your personal one, and you just beat it up ugly. You just go through and look at how many streaming services have you subscribed to in the last 6 months. You'll be dumbfounded by it, right? And how much TV have you not watched? But it's even like, think about your regular P&L for your business. You got your revenue and then you got cost of goods. Like what's going on in the cost of goods? Can you drop that cost of goods by 2-3%? It falls to your profit, right? And then all the layers of profit along the way, what can you do to get, go into each line and drop it by 2%, raise your income by 3%, just go through and do that in your personal and in your businesses. At the end of the day, you'll have a 20 to 30% increase relatively quickly. And you'll be ready for this downturn. I mean, how many new businesses are being started now too? I mean, this is a time to, a lot of businesses are going to go out of business that leave a void for something that was there that's no longer there because the person was not capitalized right. I mean, there's going to be some great opportunities to become self-employed.
Yeah. And where are you seeing those opportunities, or at least your opinion as of today in 2020? I mean, everyone's kind of initially in the beginning of, I guess, the COVID start, everyone kind of thought the real estate market would fall out and a lot of different things, but the Fed's been propping a lot up. So it's kind of a little gray, or it's hard to see into what's actually going to happen maybe the next couple of years.
Yeah. You think about like I was talking about it earlier today, in the 9 regions of the country, New York, Boston, Orlando, Vegas, Phoenix, California, Chicago. That might be 9. I don't know right now, but those are under a lot of pressure, right? because the unemployment rate is driven by the lack of tourism. Miami is another one, right? So the lack of tourism is putting a major dent in all of these areas. So you're going to have, if it wasn't for, PPP money and, extra unemployment, a lot of these areas would be in worse shape, right? The longer COVID continues and people are in lockdown, all those businesses are not getting the tourism that's coming. Eventually the tourists will return. But what's going to be left in those communities, like the suppliers of restaurants, right? A lot of them are in a lot of trouble. Okay. The corner store, the corner restaurant, the hotels, the multifamily, like I know people that have had, big apartment buildings that were in, like these city areas that their tenants aren't working. So they're having a higher incident of vacancy and people not paying, and the kids are moving out and they're going back home to live with mom and dad. And you're going from a 5% vacancy to a 25. If you don't have the right cash reserves, you're going to have some trouble. So within that becomes the opportunity, right? So the opportunity is in those areas, there's going to be businesses that are going to go out of business and somebody can step right in, unfortunately, right? I hate to say it that way, but if you're well capitalized, you can step in. I mean, the gyms are going to be, the gyms are having a lot of trouble. It's going to be interesting. I mean, I don't know about you. I don't work out well unless I'm at a gym. I don't do it well at the house.
I like to work out physical activity. I'm actually involved in kiteboarding, roller hockey, or outside. I don't like to be inside, and I like to be out and about. But, so where do you kind of see a lot of opportunity coming down the road? And do you think that's going to parlay also into real estate, or do you think real estate's kind of seeing its own bubble at the moment with the increase in, pricing?
I think, in the areas that people fled from and they came and they bought in areas like my area, right? Because I'm 30, 40 minutes south of Manhattan, an hour if you're driving 20 minutes on a ferry, an hour on a train. Prices are up. They're overpaying. Houses are going 80, 90,000 over asking price. That never ends well. It never ends well. And a lot of white collar jobs could actually be at jeopardy if we don't get the right, we don't get back to work, right? So how long can companies sustain themselves without having new sales? My biggest complaint or that I'm hearing from a lot of people is we can sustain our current business, but we're not getting new clients. We would go to a trade show and we would see those 5 people that we want to see and we cultivate them over a couple of years. We're not seeing them. We can't even get in touch with them. They don't answer an email. They don't answer anything, right? Because they're not out. But, that if you start to see a downturn or an increase in white collar unemployment, because it's really not white collar, it's really blue collar, right? It's all the restaurants and all the tourism. I know of commercial corporate travel companies have gone from hundreds of employees down to 3. These little tiny agencies that were great that would, do it for 5 or 6 companies. They're not there, right? So in that is creative destruction. There's a fantastic, opportunity for people to step in and actually do it. But the longer people are out, I see the real estate market in the flea areas dropping, and where people went to way overvalued, which means if I lose my job and let's say I have a place in Manhattan, I have a place in New Jersey, and I lose my job, which one am I going to sell? Whichever one goes first. Yeah, whichever one goes first.
That's true. If you need money, right?
My grandfather used to tell me when I'm buying it, it's the Taj Mahal, and when I'm selling it, it's an outhouse.
Yeah, that's a good. Never fall in love, right?
Never fall in love, and you got to sell something quickly. You always sell it for less than it's worth, right? So my point is, I think there's tremendous opportunity in the real estate markets coming. I don't think it's now. I think it's 12 to 18 months. I think, you're starting to see rent concessions, but people want 2-year rental agreements. Who's going to sign a 2-year apartment lease on a 25-year-old kid, coming out of college? That's dangerous.
They don't even know where they're working, right?
Right. Whether they have a job. So I think there's a lot of opportunity within the businesses that feed normal business. I think there's opportunity within travel. I think there's opportunity within the commercial real estate. I think in homes. I think having ready money, having more money available, having cash, having liquidity. This is a great time to redo all your liquidity. Make sure you got enough cash to take advantage of the downturn when it happens. Because it really hasn't happened.
Correct.
The way we think it's going to happen. And if we get all the PPP in and we get more, we get another round of stimulus, none of this could actually, the can could be kicked down the road, but there's still going to be opportunities. Still going to be opportunities.
So everyone needs to come in, look at their financial blueprint, see where they could prepare to have cash available for the opportunity that's going to come, and they'll be ready to make more money again.
I have a book on Amazon. I just published it in May. It's called It's Your Wealth, Keep It. It's like $19. You can buy the book. You can go to my website also. I have johnlsmallwood.com. And there's a whole bunch of resources. You can get a free chapter, et cetera. But, the book is designed to give you big picture, to tell you how to, to think strategically. It's a culmination of 30 years of work. We have a series of podcasts. We have a whole stuff that we're trying to do. I have a guide on my webpage download. It's called the 19 Sources of Retirement Income. Most people have 3 or 4. I'd like to get you to 19. Okay. One of those is real estate, right? 1. There's another 18 to get, so we, there's opportunity to, I think this is the greatest opportunity for everybody to rethink their entire plan, to redo their budgets, to restore their, get the debts in structure, get the liquidity right, hunker down their asset allocations and get defensive, make sure that their protection is perfect, and get into this, thing and look for the opportunities. And when the opportunities are there, most people didn't want to invest in March of 2009, nor did they want to invest in March of 2020. And you look at it, but fund flows, that was, what a time to invest. If you had, Glenn Beck back in the day was talking about the hockey stick. I don't know, you might be too young for that, but he was talking about the debt, where the debt was like a hockey stick. And in 2009, it was just going to go up and the country was going to blow up and, we're bankrupt as a country. That was wrong, right? That was one of the best times. And typically when the world is ugly and things are bad, that's a great time to invest, but the key is you got to have money. You got to have money.
That was a lot of good info you provided today on the show. I appreciate that.
Thank you.
It was good. And, we always have a final question we leave off with. And what is the biggest thing you have implemented in your life that has increased your net worth?
The concept of, when I first started out, I bought a whole life insurance policy. I bought a lot more of them since. But I used that thing 3, 4, 5, 6, 7, 8, 9 times to get myself out of trouble, but also to capitalize on things. It was having that available money set aside where it wasn't in my checkbook. And, it was there to be used. When I bought my building, I borrowed money from it. I lent it to the entity. I get tax benefits for it. The building pays it back. Like, there's so many things that you can be doing. It's that that didn't technically make me money. It's the availability of that money and the strategy of putting the money in there, because you put it in there every single month and you forget about it, right? Like, it's this systematic savings, but that has set me up so I can do charitable trusts. I can do all the things that I'm talking about if it makes sense in my financial plan in the future. So that foundation is like, I'm going to build a house. Do I build the foundation first or do I build the roof?
Got it. Build the foundation first, right?
build a foundation so that you can stem from all opportunity. If you don't have a solid foundation, we go into, I might have bought the best rental property ever known to mankind, and the market goes down and I lose my tenants and I don't have any liquidity and I lose it, foreclosure, that was bad. But if I have enough foundation, I can ride through most storms. So that's my single best thing that I ever did, was build that foundation and that mindset of that. And having that in there, I mean, there's creditor proofing. If I became disabled, it would have been continued. So many things that are depending on where you are and what your state is. And it's not the magic bullet. It's part of the overall plan. It's just part of the plan. Like, any good business has it's self-insured. Any house is insured. The most valuable person on this call is you and I, right? We run our financial strategies. We are the power of what's going on, and you're the most uninsured person in your entire financial plan. Your car has more insurance, all those things, right? For things that we hope are never going to happen.
So if people, obviously want assistance in their blueprint and building that foundation being the key number one thing, what is the best way for them to reach out to you or get a hold of you?
Well, 800-797-1000. You can call the office. You can go to smallwoodassociates.com or johnlsmallwood.com. And there's tons of resources there. On our website, there's a click here to schedule a free, no obligation call. And at the end of the call, if you're not happy with it and you don't like it, we're not going to bother you.
Well, thanks, John, for coming on. I definitely gave me a lot of things to think about, especially, into different insurance topics in that foundation. I think, I'm more planning to do at this point. But thanks for joining today.
Joe, thank you. I really appreciate it. I love to have the conversation, because the free forming of just figuring out where we're going, nobody knows where the heck we're going to go. It's just have a good plan and go forward and take your tax benefits when you can and have that balance. So thank you. I really appreciate it. Thank you.
All right. Enjoy. Hey, everyone. Thanks for watching my latest interview. If you like what you saw, please click the subscribe button below to become a member of the Joe Robert community. Be sure to hit the bell to turn on all notifications so you always know when I post a new video. Tell me what you thought about the content in the comments below. I always read them and would love to answer any of your questions.